Want to know the secret to turning a welder's paycheck into a $500,000 portfolio that spits out passive income like a money machine? I'm talking about building wealth the smart way, through dividend investing, just like my guest today, Russ from Dapper Dividends, who's crushing it with a verified $500,000 portfolio and a net worth nearing $1 million. Today, I'm diving deep into Russ's journey, from blowing cash in his 20s to mastering dividend growth, and why he's betting big on funds like SCHD to fuel his financial freedom. In the next few minutes, you'll get the full scoop on his strategy, his top holdings, and why he's steering clear of trendy high-yield ETFs like YieldMax. Stick around for actionable tips and some hard-hitting truths you won't hear elsewhere. Let's get started. Meet Russ, the welder-turned-dividend guru. I'm thrilled to share the story of Russ, the man behind Dapper Dividends, who's joining us today, virtually, but will catch up in person at a Blossom event in Chicago soon. Russ is a 47-year-old welder from Chicago, a red-blooded blue-collar guy who's been welding since 1999 and became a passive income addict in 2018. His Blossom bio paints the picture: a $500,000 portfolio, verified by Blossom, with a net worth pushing $1 million, delivering a 3.44% dividend yield thanks to heavyweights like Ares Capital, SCHD, Realty Income, Main Street Capital, and VC Properties. You can check out Russ's portfolio, and mine, for free on Blossom via the link in the description and pinned comment. Russ's story is relatable. Growing up lower middle class in Chicago, he had zero financial education. His grandparents' only advice was, save 10%, but they didn't explain how. In his 20s, Russ joined the Navy, where he admits to blowing his money on drinking, gambling, women, and concerts. Sound familiar? It wasn't until his late 30s, around 2018 at age 39, that he got serious about investing. A Scottrade commercial, remember those $5 trades, sparked his curiosity, but he wanted to trade for free. That led him to Robinhood, where he started with penny stocks. Spoiler, it didn't go well. He dabbled in swing trading, taking Udemy courses and watching YouTube, but his emotional decisions kept breaking the rules. Then came a light bulb moment during a swing trade with Merck, MRK. Russ received a dividend payment and thought, wait, they just put money in my account for owning this? That sparked memories of his grandfather mentioning dividend stalwarts like Walmart, Disney, and AT&T. Down the rabbit hole he went, discovering Warren Buffett and Charlie Munger, whose philosophy of buying quality companies and pretending the stock market is closed for 20 years changed his life. Today, Russ shares his journey on YouTube, a newsletter, and Blossom, with 90 weeks of posts showing his portfolio's growth. Let's unpack why he chose dividend investing and how he built that impressive portfolio. Why dividend investing? Why did Russ pick dividend investing over growth stocks or high-yield covered call ETFs? He boils it down to three key reasons. First, it's about stable quality companies that offer peace of mind. At 41, when he got serious, Russ initially chased high yields, but he quickly learned that mature dividend-paying companies like Microsoft or Zoetis, ZTS, provide stability and growth. Zoetis, an animal health company, is a favorite. Think pharmaceuticals for pets and livestock. With a growing dividend and a focus on a booming sector, aging populations and pet ownership are surging. It's a perfect fit for his long-term mindset. These companies aren't flashy, but they're built to last, giving Russ confidence even in volatile markets. Second, he learned the hard way that high yields often mean high risk. Early on, Russ chased juicy payouts, but noticed they underperformed growth stocks on total return. He mentions JEPI, JP Morgan Equity Premium Income ETF, and JEPIQ, which sell covered calls for 7 to 11% yields but sacrifice upside. Compared to the S&P 500, VOO, or NASDAQ 100, QQQ, they lag significantly. For example, JEPI's total return since inception is about 15% annualized, while VOO has averaged 20% in strong markets. Russ prefers lower yield, high growth dividends like SCHD's 3 to 4%, which grow faster over time. Studies show that after 8, 10 years, low-yield, high-growth dividends often outpace high-yield, low-growth options, creating a snowball effect. Third, Russ loves the simplicity of dividend growth investing. He's a busy guy, welding, raising 2 teenage daughters, and running a YouTube channel. He doesn't have time to micromanage trades or analyze complex option strategies. Dividend ETFs like SCHD with its 100 quality, dividend-growing companies are set and forget. The fund's algorithmic rebalancing screens for quality, kicking out stocks like Broadcom when their yields drop too low. This hands-off approach aligns with Buffett's advice to buy and hold forever, letting compounding work its magic. Russ's portfolio, a dividend growth powerhouse. Russ's $500,000 portfolio, as seen on Blossom, is a masterclass in diversification and discipline. His top holding is SCHD, Schwab U.S. Dividend Equity ETF, which tracks 100 high-quality, dividend-growing U.S. companies with a 3 to 4% yield and 10% plus annual dividend growth. Why SCHD? Russ loves its quality screening and automatic rebalancing, which removes emotion from the equation. Held in his Roth IRA, its dividends are tax-free, and he plans to let it snowball for decades. For example, $10,000 in SCHD at a 3.5% yield growing 10% annually could generate $1,200 a year in dividends after 10 years without touching the principal. He also holds VTI, Vanguard Total Stock Market ETF, for broad market exposure, capturing the S&P 500 and beyond. REITs like Realty Income, Agree Realty, and Vici Properties are in his retirement accounts, as their 90% taxable income distributions are tax inefficient in taxable accounts. Russ is consolidating from Realty Income into Agree and Vici, which have stronger growth. Agree has returned 12% annually over the past decade. Business development companies, BDCs like Ares Capital, 8% yield, and Main Street Capital add income from middle market investments, but he keeps them small to manage risk. A small, fun position is 10 shares of SOXL, a 3x leveraged semiconductor ETF. Bought at $10 in April 2025 during a dip, it's a speculative play, not a core holding. Russ also manages custodial accounts for his daughters, holding SCHG, Schwab U.S. Large Cap Growth ETF, for growth exposure, but he's cautious about adding more growth to his own portfolio since VTI already provides plenty. His international exposure, like SCHY, Schwab International Dividend Equity ETF, bets on global dividend growth, as he believes international stocks will shine in the coming years. SCHD is Russ's cornerstone, and for good reason. Its 100 companies are screened for quality. Think strong balance sheets, consistent earnings, and growing dividends. With a 3 to 4% yield and 10% plus dividend growth, it's a compounding machine. For instance, if Russ's $100,000 in SCHD grows its dividend at 10% annually, it could yield $6,700 a year in a decade, rivaling higher-yield funds without the risk. Unlike DGRO or VIG, which some investors prefer, SCHD's algorithmic approach avoids human bias, and its low 0.06% expense ratio keeps costs minimal. Russ holds it in his Roth IRA, ensuring tax-free income forever. Despite some investors selling SCHD for higher yield options, Russ is steadfast, believing its quality and growth will outshine fads over the next 10 years. Is 3.44% yield too low? Russ's portfolio yields 3.44%, which some might call low compared to covered call ETFs boasting 50 to 100%. But Russ isn't phased. He prioritizes quality over yield, knowing that chasing high payouts often leads to underperformance. For example, Buffett once illustrated that a non-dividend stock, where you sell shares for income, can outperform a dividend stock because reinvested earnings fuel faster growth. Russ missed Nvidia's meteoric rise due to its 0.06% yield, admitting he didn't understand semiconductors. But he's okay with that. His focus is on companies he can predict 10 years out, like Zoetis or PepsiCo. At 47, Russ is in wealth creation mode, not preservation. His 3.44% yield, combined with 8 to 10% dividend growth, could double his income in a decade without selling shares. For instance, $500,000 at 3.44% yields $17,200 annually now, but at 8% growth, that's $37,000 in 10 years. He's not worried about low yield because his dividends are a snowball, rolling bigger each year. In retirement, he might shift to higher yield assets, but for now, quality trumps chasing payouts. Russ's take on YieldMax and high-yield ETFs. What about YieldMax and those 50 to 100% distribution yield ETFs? Russ is skeptical, calling them ticking time bombs at worst and underperformers at best. Funds like MSTY, MicroStrategy, or TSLE, Tesla, promise sky-high yields but lag their underlying stocks on total return. For example, MSTY's total return since inception is 20% annualized, while MicroStrategy's is 35%. The issue? High distributions, often including return of capital, ROC, deplete the fund's NAV, net asset value. Russ finds their complexity, tax loss harvesting, derivative swaps, and fluctuating ROC, confusing and risky. He cites a Roundhill ETF, KNGS, that shut down after less than 2 years, erasing its performance from the books. Retirement goals and income needs. Russ's definition of retirement is freedom, doing what you want, when you want, with whom you want. At 51 or 52, he plans to take a year off welding, which he's done since age 21. With 2 daughters, 17 and 18, soon leaving home, he and his wife aim to live on $40,000 a year, covering bills, travel, and frugal fun. Their mortgage will be paid off, keeping expenses low. Russ estimates $20,000 in annual dividends from his $500,000 portfolio at 4% yield could cover half, with part-time work or content creation, YouTube, newsletters, covering the rest. He's open to working part-time at Costco for fun, valuing purpose over idleness. A $1 million portfolio, per the 4% rule, could sustain $40,000 annually without depleting principal, assuming 8% market returns. Russ isn't afraid to sell shares in retirement for extra income, especially since long-held stocks are tax-efficient. Long-term capital gains at 15 to 20% versus ordinary income at 24 to 37%. For example, selling $10,000 of VTI annually at a 15% tax rate nets $8,500 versus $7,600 from dividends taxed at 24%. He's flexible, knowing his $1 million net worth, including home equity and 529 plans, gives him options. The power of the dividend. Snowball Russ sees the dividend snowball as just compounding by another name. His $17,200 annual dividends could grow to $37,000 in a decade with 8% growth without adding new money. He's skeptical of calculators projecting $100, 000 plus in dividends as they assume perfect conditions. A 50% market crash could have dividends temporarily, but Russ believes quality companies recover. He cites Charlie Munger. Don't interrupt compounding unless absolutely necessary. Emergencies happen, but Russ reinvests dividends strategically, letting them pile up as cash before deploying into undervalued opportunities, like VTI at $307, now $317. How Russ built a $500,000 portfolio in 7 years. Starting at 39 with little savings, Russ built a $500,000 portfolio by 47 through frugality, high savings, and smart investing. He and his wife, a single-income household, save 35 to 38% of their income despite raising 2 teenage daughters. His welding job pays over 6 figures, a rarity for a high school grad, thanks to demand for skilled trades. They track every dollar, avoiding paycheck-to-paycheck living. After maxing out 401 Ks, Roth IRAs, 529 plans, and an emergency fund, extra cash goes to a taxable overflow account at Schwab. Russ rates his portfolio's risk a 2 out of 5. With 85% in low-cost ETFs like VTI and SCHD, he's diversified across thousands of companies. Small positions like Hero Incorporated, HRO, an ophthalmology stock, add risk but are minor. Even treasuries carry inflation risk, so Russ accepts market volatility, believing the S&P 500's long-term upward trend, 10% annualized since 1926, will prevail. A 40% crash would sting, but he'd be thrilled to buy quality stocks at higher yields. For example, SCHD's yield could jump from 3.5% to 5% in a crash, letting him scoop up more shares. If the market collapses permanently, he jokes, we've got bigger problems than portfolios. Studies favor lump sum investing, as markets rise 75% of the time. Missing the 10 best days in a decade can have returns. $10,000 in VTI from 2010 to 2020 grew to $40,000, but missing the top days left you at $20,000. Russ dollar cost averages, DCA, out of necessity, as he doesn't have $100,000 to dump in. He sometimes lets cash pile up when markets feel pricey, like VTI at $307, but admits this can backfire. Lump sum wins statistically, but DCA suits his steady income and discipline. Where to find Russ's journey from a spendthrift sailor to a dividend investor with a $500,000 portfolio is proof that discipline and quality win. His focus on SCHD, VTI, and REITs, yielding 3.44% with high growth, sets him up for $40,000 in annual income by 51, with flexibility to sell shares or work part-time. He avoids YieldMax's high-yield traps, prioritizing simplicity and long-term wealth. Russ's frugality, high savings rate, and Buffett-inspired mindset show anyone can build wealth even without a degree. What's your plan for financial freedom? Drop it in the comments. If you love this, smash that like button. Our puppy mascot did. Subscribe to Dapper Dividends on YouTube and check out our last interview on your screen. Keep crushing the stock market and take it easy. Peace.